Hi, it's Darren, and welcome to February 2023. It's a good thing I didn't put this outlook together for us in January because there's been a lot of news that's come out about the economy, and the market's had some really interesting moves. So it's been a bit of a surprise. So why don't we get us caught up, and I'll share with you what's been happening, some of the charts I look at, and some thoughts about where I think we might be headed. So first of all, we'll begin with a word from our lawyers. So 2 out of 3 dentists agree. Objects are closer than they appear, and your mileage may vary. Okay, let's move on. So this is, if you've been just watching the news in the last little bit in markets, you're like, what the heck's going on? It's a bit surprising. Because last year, 2022, we had a lot of shocks to the system. We thought, the pandemic was enough, but we didn't. We had a lot of big things happen. The first one was that after telling us for a long time that interest rates would stay low, well, they didn't. Central banks around the world, particularly US and Canada, raised rates dramatically in 2022. And that really put the brakes on the stock market and the bond market, which I'll show you in a minute. And that really hit most balanced and well-managed portfolios really, really hard. We also saw global supply chain issues continue to have problems because inflation became really, and I've been telling you about inflation for a while, but inflation went from, oh, it's transitory to, oh, actually it might be baked in the cake more than we thought, which is why interest rates went up so much. We also saw in Russia and Ukraine that crisis escalated, and the brave Ukrainians seem to be willing to fight to the last person, which is remarkable. So that conflict obviously got larger than anyone expected and has lasted longer than anyone expected. So you put those three things together, pretty crummy year in the market. 2023 so far, remarkable. So we had a huge move in interest rates. I think the market now is hoping that that's going to slow down. So January and February have been actually really, really solid. And I'll show you that in a second. But first, just to remind you, last year was pretty crummy. Now, our client accounts have done very well in the face of that. But you can see if we look at just that period of 2022, markets, we know markets go up and down. We've been investing for a long time, so we know that. But you can see how exceptional and rare that experience of 2022 was. Certainly, in our case, it's probably been the worst year in about a decade for clients. So it's a bit of a reminder that markets can be volatile, not a fun one, but certainly one that if you think it's going to happen again, well, statistically, not likely, not impossible, but not likely. So it's good to keep that in mind, I think. Valuations came way back down in a rush. We saw valuations got a bit extended because there was so much money printed. But I'll also remind you, and I've mentioned this many, many times in the past, that the S&P 500, that's the largest measurement of companies in the United States, but measured by size of company. And I've been warning for a while that that weighting of the top technology stocks was really moving that whole index around. So the biggest, 5 or 8 companies were having the biggest impact on where the market would go, or at least the measurement of the market. And so it was like a toddler with a big head. They kind of tip over and they got to follow their melon. And that led to, being very aware of the fact that if we invested in the 500 stocks, a lot of the money went to the biggest companies. Canadians remember that effect well from like the 1990s when it was DS, Uniphase, and Nortel driving most of the market. So because those few companies became overweighted, when they came down, well, they also dropped down that index as well. So you can see we had a really quick over-acceleration, if you will. Valuations got too expensive, really because of that domination of those large tech companies. But we've also seen it come back down really, really quickly at the end of 2022. Now, in the longer term, you can still see that we're certainly down, even though we've had a rally since January, we're still down from the peak that we saw at the beginning of 2021. So 2021, 2022, we had a really, really nice move back up again. And that bull market seemed to be a bit over because of COVID. But then they spent a ton of money. As you can see, we had that huge run up. So if you got scared in 2020 and you sat it out, you missed a massive bull market. And then when, hey, all the flashing green lights are going at the end of 2021, well, guess what? That's exactly when markets decided to go back down again. 2022 was lousy. If you decided to exit at the end of 2022 and said, geez, I'll wait for the coast to clear, you missed a sudden surge up. So I think the trick for most investors is however you're feeling, don't do that. If you're feeling all exuberant, maybe calm down. If you're feeling really scared, put money in, because that seems to be the trend of things. Year to date, so far, we're up over 7% in the S&P 500. So those big tech stocks had a big rally, but it's really pulled up pretty much everything. So as I say, anyone that decided in December that was like, oh, I'm going to wait a bit until some of these things slow down or get better or coast is clear or maybe they'll show a fat flashing green light on BNN Bloomberg or something like that. No, doesn't work like that. So really, I think as investors, we've got to take away the message that markets are unpredictable in the short term. So we've been very fortunate. We stayed invested as we should have, and we've recovered very, very nicely so far this year. So fingers crossed that that continues. Now, we've had a lot of talk about the Great Recession. Everyone seems to think one's coming. And if they are, well, this is probably the most anticipated recession of all time. So this is a chart from Bank Credit Analyst, one of the research outfits that we use and subscribe to. And we can see that most professional forecasters all seem to agree that, hey, we're going to get a recession, which means we may actually not. And it looks like what the central bankers are trying to engineer is what's called a soft landing, meaning that they slow the economy down without putting the car in the ditch. We'll see if they can do that or not. I don't think as an investor it makes a lot of sense to worry too much about this. So I'm going to show you this section of this charts from all the big recessions we've had since the 1960s. And it shows us what unemployment did, what the market did, when the recession happened, when markets were low. And I want you to look at that for a minute, and I want you to see what pattern you can take. So what can we learn from past recessions? What data points can we look at to see if it's predictable? You done? Good, because there aren't any. Every single one of those is completely different than the other one. So trying to interpret what this recession could look like based on the data from past recessions, completely useless exercise in my opinion. So there's really not much we can learn because every single one is a bit different. Yes, there might be a few commonalities, but in the general way, every single one of them is a little bit different. So I don't think there's a whole lot to be trying to interpret from that. So if we get a recession, and this is actually to me one of the problems, is that but a recession is just two quarters of negative GDP growth. But by the time you actually know we had one, it's already long over. And markets move in advance of all these things. So there's no point in worrying about it, in my opinion. Bank Credit Analyst, if you want to look at their betting line, if there's a pro line for this, they actually look at what they think would be about a 70% chance of a mild recession, but an outside chance of not too bad and an outside chance of really horrible. So who knows? So as I say, I like to invest like I wish I could play golf, just hit it down the middle of the fairway. So we're not worrying a lot about if we get a recession or not. And actually, I think, to be honest, the longer people think we're going to get one, we won't. And as soon as everybody thinks we won't get one, we will. So don't worry about it a whole lot. So there we go. So I just circled the middle of the road is where they think it's going to be, and they put a 70% probability of that, which makes sense to me because the central bankers seem to be engineering one. So they will probably get one, or they're working really hard at it. So let's look at our Dos Equis guy and talk about some items of interest as I look through all the charts and chart packages and that kind of thing. The first one is labor. There are so many job openings, and it's very, very difficult for a lot of industries to find people that were willing to work. So this is actually one of the unique things about this particular potential recession is how do you have one when employment is so strong? And this is why I say at the beginning, good thing I waited to do this particular outlook, because the data we've been receiving on employment in the first part of 2023 has been shockingly strong. So in Canada, just this week, we had the job numbers come out for January, and it was 10 times what was forecast at 150,000 jobs versus the 15,000 that were created. Labor force participation is about 66%, which is very, very strong. Lots of jobs created. Wage growth is running very, very strong at about 4.7%. And unemployment is low at about 5%. That's historically very, very low. U.S., we saw blowout numbers from them earlier in January, or I guess I should say early in February when the January numbers came out. And we are seeing in the United States, unemployment is under 3.5%, which is the lowest level since 1969, the year I was born. And you've got to go back to the 50s to find numbers that are lower than that still. So and also again, we've seen wage growth do well. So it's really weird to think that we'd have a recession when labor is so strong. That's a very weird thing to think could happen. So that's a unique one. And as I say, labor, if we look at what's called the JOLTS, or how many job openings are available for a job seeker. There's 1.72 jobs available for every person seeking a job in the United States. So, and it's backed off a little bit, but still lots of opportunity out there. Home prices have become A little less affordable in the short term. We were worried about home prices getting a little out of hand everywhere, but that's actually one of the results of raising interest rates so sharply as they've done in both Canada and the United States. So we've seen the housing affordability come down a bit, but the average American household still remarkably strong balance sheet. Debt service incredibly low. It's gone up a bit because cost of debt has gone up. I warned you on one of my Walking with Charlies from almost a year ago to start paying down consumer debt because it was going to get more expensive. Didn't know they'd raise interest rates as much as they did, but certainly the clouds were on the horizon. And the excess savings that we've seen build up in the U.S. in particular, those have been drawn down. And that's actually probably good for the U.S. banks because there's just too much money sitting around. So that cushion that the average American has had, they are going through it now. So that they have been saving for a rainy day, and I guess it's raining in some places. But again, lots of job openings. Okay, so there's the balance sheet I talked about, assets to liability, still very, very powerful. Okay, moving on. Oil and energy, another one very interesting. In my career, I've seen oil go all over the place. I've seen it go to over $100 a barrel. I've seen it at about $5. So moves like crazy. So it has actually been going up, and we've been allocating to energy for the first time in the last year or two in my career. I always stayed away from it, but some of the reasons I stayed away from it are the very reasons structurally to go back in. And we've seen oil have a big move up. It's backed off a little bit. But the number I want to really have you pay attention to is more of the structural issues that I think we're going to continue to see a fairly permanently high oil price, relatively speaking. And that's because if you look at how many oil rigs there are, they're bringing more on stream, but this isn't the kind of thing you can just switch them on very quickly. And yet look at how quickly inventory of oil in the United States in particular has just been dropping. And, you know, the U.S. has been dipping into the strategic reserves of oil to try and, in the short term, maintain a reasonable energy price, again, to try and keep a lid on inflation. But you can't play that game forever, people. So this is actually quite good news, and it would be really good news for Canada if we could actually maybe sort out some of the politics of getting our energy to global markets. But I think as an investor, this is a place where there's probably some very good long-term opportunity for us because of these structural changes that were 30 years in the works. That I think now we're all going to pay the price for that. But at the end of the day, we don't want to use oil anymore, right? It's bad for the planet. So we're also looking at how we maintain the right investments to global energy as it moves in transition to renewables. And we're seeing that the cost of these things is actually finally getting to be much, much lower. And hopefully technology will continue to drive the lower cost of that. And really, in my view, if climate change is the thing we're all going to worry about, the only way the Western world can really fix it is through technology and innovation, because you have to get the price of that down. Because the largest polluters in the world are countries that don't have the same standard of living that we do, but they want our standard of living. And they will not get there without cheap energy. So if oil and coal are cheap, that's what they're going to use. So it's really incumbent upon, I think, the Western world to drive the cost of alternatives and renewables down so that they are going to be used in wider adoption. So that's what I think is going to happen. So we're trying to make sure we've got the right investments there, because I don't think that trend's going away. Interest rates, really probably the biggest story of 2022. I love this because you start referring to interest rate as the VIG, the little Sopranos reference there. Look it up if you don't know what that means. Inflation, again, talked about that before. Inflation really jumped in 2020 for lots of reasons: money printing, global pandemic, supply chain issues, lots of things. But the cost of going to the grocery store, gas station, anything else really surged. We all felt it and noticed it. So they decided to slam on the brakes. And interest rates jumped dramatically in 2022, more so than they did in in 2004. Last time we saw rates jump up so much. Now, there's been a lot of attempted comparisons to compare Chairman Powell to Chairman Volcker from the 80s, who broke the back of inflation by raising interest rates from about 10% to 20%. I'm sure there's some of you watching that remember who had mortgages and things that were at high double-digit cost. Hopefully we never see that again. But what's important to realize now is that interest rates, by Chairman Powell, he didn't raise interest rates by a double, which is what Volcker did. He's raised them about 16-fold. So even though it's coming from a lower base, the percentage increase off of that has been way more dramatic than anything Volcker did. So I think it's a good argument that he has slammed on the brakes of the economic car really, really hard, more so than I think the market anticipated that would happen, because they were left rates at really emergency wartime rates for so long. You can see that I think for most, if you're 30 or 35 now, you don't know you've never seen this stuff before. This is not something you've ever experienced. We had that little bump up as, we thought we'd get to normalized rates, but they dropped them so quickly. The market doesn't quite know what to think about this. I think some participants in the market are hoping rates decline quickly. I don't know. I think Powell is trying to predict or telegraph, if you will, that rates will stay a bit high for a bit longer than market thinks. But I don't know. Nobody else does either. But this idea that rates may drop quickly, we'll see. I don't think that's not the game I'm playing. I think we're going to see them kind of maintain at a reasonably high rate for a bit longer. They're not going back to 0.25, that's for sure. And because the way that bonds move, people used to perceive bonds as being safe. We've been very, very low in our fixed income allocations in our portfolios for a long time, just because bonds move inversely to interest rates. So if interest rates go up, bonds go down. And when interest rates were at the bottom of the graph, there was really no way for rates to go at some point, which is up. And they did, and when they go up sharply, bonds get hammered. So we watched the U.S. Bond Aggregate Index, which is a measurement of the biggest bond index measurement that is available. It had its worst year on record, which is 47 years. So dramatically bad period of time as bond investors. And that really, I think, alarmed some people because they perceived bonds to be safe. So they didn't think the safest part of their portfolio would be hit as hard as it was. So this is why we stayed very much away from fixed income. Although that you could argue that wreckage is over now because it is so rare, but certainly a fairly historic experience in 2022. And equity investors are used to volatility, but bond investors, no, they're not. So this really, I think, surprised a lot of people. Not me, though. But we have to remember that the fixed income market is about 3 times larger than the equity markets. There's lots of variation within there, lots of things to go shopping for, which is what we're doing now. But clearly, they all got hit pretty good. We can also see, I think this chart is interesting, is what happens if we see a 1% rise or fall of interest rates. And what I wanted to show you here was that because there's so many different types of bonds to buy, they've all got slightly different responsiveness to or impact on what interest rates might do to the underlying return. So this is why we're shopping carefully here. It's not as simple saying, well, let's just buy bonds. It's like which ones and how do we want to allocate to them. So Christian and I have been working very hard on a project to really figure out what we think the sweet spot is as we increase our allocations back to where historically they probably should be, but we haven't been for a long time. And actually, there's been a lot of conversation in the investment world about is it the death of the 60-40 portfolio? And a 60-40 portfolio would be 60% blue chip companies and about 40% investment grade bonds. And that is a bit of a neutral benchmark for a lot of pension plans. And the Globe and Mail interviewed me back in January about this. And I said, actually, I don't think it's the death of that. I think that would have been true maybe 3 or 4 years ago. I think actually now we're seeing the rebirth of it. It's now possible for investors to begin drifting back towards, call it that neutral, balanced mix, depending on their own risk tolerance and objectives. But certainly, we haven't been 60-40 for a long time, but now we can start moving back towards that. And of course, it will individualize it for you. But that's where I'm really glad Christian's on the team to help us do a lot of the work. And I'll be back to Christian on something else in a minute. The other reason why this is interesting is because of that decline, we're seeing yields now in so many sectors of fixed income be at amongst the highest they've been in the last decade. So very attractive now, I think, for a lot of fixed income investments to be put in to get yield. And I also think it's interesting because most people will not do this left to their own devices because they'll look at the returns from the last year or two and go, oh, I don't want to own this, thinking that, well, that happened, it will repeat, which is exactly what it says not to do on the disclaimer for every investment product. They all say past performance is not indicative of future performance. Actually, in the fixed income world, it could actually be a flashing green light. The worse it was, maybe the better it ought to be going forward. But we'll come back to that in a bit. So pension-like investing. So I talked about a balanced 60 portfolio, and yeah, I wish I had a long-range crystal ball because I'm not from the future. But the 60-40 model they talked about, it had its worst year since 2008, and there was a point there actually in 2022 where it was very close to being its worst year on record. So the last time we saw it being that bad was the global financial crisis in 2008, and then you had to go all the way back to 1974 to see another point in time where it had really, really crummy performance. So again, it's not that it can't go down, it's just the degree to which that a blended 60-40 neutral benchmark portfolio dropped was shocking to many, many people. Fortunately, we outperformed that number in most of our client accounts, which has been great. But at the end of the day, it was, I think, a surprise to even conservative, prudent investors that 2022 was so lousy. But I will say this, that investing actually is easy because it really is just a process of buy good quality, stay diversified, stay disciplined. But predicting the future is really, really hard. And I think most people get in trouble when they confuse the two because we really have to try and not do a human thing, which is try to read the tea leaves and see the future. I think we really have to make sure that first we stick to our principles, stick to our discipline. Yes, we have to adjust the sails a little bit depending on which way the wind is blowing and where the waves are. But at the end of the day, we have to follow the process. And I'm going to give you a second here and look at why I say that. So this is going back to 2008, different categories of investments and kind of which was the leading one. And you can see how they were ranked. So which had the best performance down to which had the worst performance in that year. So I'm going to give you a couple seconds. You can freeze this if you want and see if you can identify the pattern that exists in here to help predict what the following period of time may be able to accomplish. So in other words, if you look at what the past series of bets, what performance was, what would your bet be for the next several years moving forward? So just pause this if you want, take a few minutes and see if you can identify the pattern. Okay, time's up. Guess what? There isn't one. So trick questions. See, you got to know if I'm doing quizzes on this. I'm not going to really give you the true answers because there aren't any. So what I've done now is I took that same basic chart and now we've overlaid an asset allocation model, which would be, a mix of all of them together. And you can see that's really why, from a process and discipline perspective, it seems to work the best because you're never the top, you're never the bottom, you're always kind of in the middle. So you never, make enough to really make a killing, but you never get killed either. And now that doesn't, cause a lot of people excitement. I've always said that investing should be boring and it should be like farming. That's about as exciting as it should be. So again, if we just focus on staying prudent, staying diversified, we generally do really, really well. We never are at the top. We're also never at the bottom. So there you go. Play that one with your friends if you'd like. I also know that people, when they do try to predict the future, they do very poorly. And so every year, Dalbar does a thing called the quantitative analysis of investor behavior. And what was really interesting for the 2022 numbers, they actually found that investors did worse. They underperformed their own investments, which we know historically investors do because they buy and sell at all the wrong time. But we found that in 2022 was probably the worst gap ever about how much people underperformed their own investment. So if they just bought the thing and left it and never touched it, they did better than touching it. So, there's an old joke that says investing is like a bar of soap. The more you touch it, the smaller it gets. Pay attention. It's true. Okay, so I want to move on. We're going to talk about Christian for a second. Christian has a CPA, so he comes to us already very well regarded as an accountant. He's now also becoming an analyst. He did level 1 of the CFA exam, Chartered Financial Analyst exam. That's probably one of the hardest designations to get in our industry. It's a global designation. So he wrote level 1, which is the hardest of 3 levels. And he was in the top, I think it was actually the top 7 or 8% of all students who wrote it globally. So yeah, he's our whiz kid. Christian also is going to, I think what we're going to do is Christian digs into a lot more of the data now. So I think we'll have him start doing some of these videos as well. If you really want to go on like deep dives into some of the stuff we're looking at, I'm going to have Christian start doing that. And that'll give you a chance to get to meet our young whiz kid. He's also going to start joining some of the client review meetings with Nick and Pedro, so you get a chance to meet him, and he'll maybe explain a little more of the work that he's doing on our behalf. So let's wrap up. So a few things. Number one, we're going to stay invested. Markets are volatile, always are, but I think the risks, as we saw, especially in the first part of this year, much, much higher to try and sit things out, and timing it really is a mug's game. This push and pull of interest rates, recession, global macro issues, Ukraine, Russia, China, this is going to continue to create volatility. So we're actually going to try and put some things in to take advantage of that, which I'll cover in a minute. But I really want you to ignore the press. Their job is to make you kind of lose your marbles. So try to do your best to turn it off. I've mentioned before, my advice is do not watch BNN Bloomberg unless I'm on it, and I haven't been on it in years. Higher interest rates have changed how we're building portfolios, and they're bringing back, which is good news, a whole category of investments that we really stayed away from for a long time. So that's really, really positive. And I think it also ties in well as our clients, many of which are getting older, and retirement is either they're in it or it's coming or they're through it pretty well, and they want to have a little more stability in their portfolios and more income in their portfolios and regular income. So that's good. So those, as I say, those tools that we stayed away from for a long time now are actually appealing and attractive again. We are taking advantage of volatility. We've been adding a lot of covered call strategies into our pooled fund and other places, and I will probably do a whole Commonwealth Academy on what those are, but those really, one of the components of them is they allow us to convert volatility into an income source. And I was just interviewed by the Globe on another article that will be coming out shortly, which we'll be sure to send to you when it's published, where I talk about some of the new products that have come that on the market that have allowed us to, I think, do this with a little more precision, which is really, really helpful. And obviously our focus on healthy dividend-paying companies really paid off last year. That was a really, really good benefit from us. Obviously, we lost money because everybody did, but it really helped cushion the blow, and I think that positions very well for what's coming next. And again, we're going to protect what a dollar buys. I know that things like GICs look tempting. They look like, wow, I can get 4 or 5% in a GIC, but that's the siren call of a mistake where we have to always be focused on growing your purchasing power. And things like GICs, they might be good if you're buying something in the next year, although we have even better alternatives than that because we don't want to tie up your money like that. But as I say, the trick is not to protect the dollar, it's to protect what a dollar buys. And so we've got much better tools to be able to accomplish that. Okay, that's about it for today. I want to thank you very much for watching to the end. We're very close, I think, knock on wood, to hiring another financial planner who's going to take some of the work off Ryan's desk, which is good. So we'll have hopefully news on that shortly, as well as some other changes and things we've been working on for 2023. So lots in the pipeline that I'll share with you as the year unfolds. So with that, thank you very much for your time and attention. If you need anything, reach out, give us a call, send us an email, and we'd be happy to help. Talk to you soon.